This is the third in a series of resources that consider the journal entries needed for various basic transactions. Part 1 introduces the general journal as an alternate method for bookkeeping. We then consider the journal entries needed for acquiring cash and other assets. Part 2 looks at the journal entries for selling goods. Part 3 focuses on the journal entries for collecting cash and paying other obligations. We have discovered how to create the general journal entries for a number of different types of transactions, including borrowing cash, acquiring assets, selling goods, and making cash purchases. Some of these journal entries were relatively simple, listing the date of the transaction, the account to be debited and how much that debit would be, the account and amount of the matching credit, and a brief description of the transaction. Compound journal entries are more complex, as there are more than two accounts affected by a specific transaction. What we have not yet learned is how to journal for collecting cash owed a company, paying amounts owed another company, or paying back on a loan. Recall that on November 15th, 2016, 8 Banners Amusement Park bought $12,500 worth of souvenir plush toys from Polly's Plushies on credit. 1 week later, 8 Banners sent a check for $5,000 as a payment on that account. How do we enter this transaction into the general journal? As always, we start the entry with the date of the transaction. Next, we have the account that is debited. In this case, since Polly's Plushies is gaining cash and assets increase with debits, we have a $5,000 debit for the asset account, cash. But what account is credited in this transaction? The cash payment is to lower the amount due Polly's Plushies, which is their accounts receivable. So the matching entry will be a credit of $5,000 to the accounts receivable. The journal entry ends with a brief description of the particulars of the transaction, where the payment came from, and what the original purchase was. Note, however, that there is no mention of revenue. The transaction simply transfers assets from one account to another. Revenue for a sale is recognized at the moment of the purchase, not when the cash is collected. Of course, Polly's Plushies has bills of their own to pay. For example, they need to pay off You Dirty So-and-So Sewing Supply Store for the raw materials purchased to make the plush souvenirs. Once the payment cleared, Polly was able to send a payment to the supply store, paying the account in full. For the journal entry, we start with the date of the transaction, November 23rd, 2016. Recall that liabilities accounts decrease with debits. The debit goes into accounts payable in the amount of $1,500. This is matched by a credit to cash. As always, the journal entry ends with a brief description of the transaction, stating where the payment went and what the payment was for. Polly also needs to make a payment on his mortgage with Last National Bank, which he does on November 23rd, 2016. The amount of the payment is $3,500. However, not all that payment goes directly toward the actual loan. Part of the payment is used to pay the interest built on the original loan amount. Therefore, there are actually two accounts debited: interest expense and notes payable. The notes payable reflects the portion of the payment that actually goes toward the principal of the loan. The credited account is cash. The description explains the destination of and reason for the payment. As way of a summary, let's consider the process needed to create any general journal entry. First, we need to determine what accounts are affected by the transaction. Be careful, because sometimes these affected accounts may not be so obvious. Then we need to determine if the amount in each account will increase or decrease. This will also help us figure out whether to enter the amount as a debit or a credit. Recall that any asset account increases with debits, decreases with credits. Liability accounts increase with credits and decrease with debits. For owner's equity accounts, first we need to determine if it is a revenue or an expense. Revenues increase with credits and decrease with debits. Expenses increase with debits and decrease with credits. The final step for entering a journal entry is to determine exactly how much each account changes. This is especially important when we have some form of a compound journal entry. So long as we follow these basic steps, we can make a proper journal entry for any sort of a transaction.